This evening, we continue with a conversation that started last week. Now, last week we touched on Minister Kodongwana's game-changing announcement regarding tax breaks for solar panel installations, specifically aimed at homeowners. Today, we're going to continue that conversation, but we're going to be focusing specifically today on businesses because it appears that there are different rules for the application of the principles that give you a rebate if you're a business and differently if you are a homeowner. In other words, not a business, right? So we're going to have that conversation. And many questions have arisen about the implementation of this process. So we've split the discussion in two. Last week, we spoke about you as an individual. If you buy solar panels and what are the chances of you getting that tax rebate. But today we speak of businesses that do exactly the same thing. And joining me tonight are Frans Tomasek. He's head of legislative policy at SARS. And then Delano Abdoll is going to be helping me ask the questions in ways that are at least a lot more intelligent than what I am. And I've asked him to be part of this conversation so that when I do ask questions, they are not too strange. And then, of course, and he is a leading expert in cross-border taxation, and he is from a company called Tax Consulting SA. Haley Reynolds joins me, also director at Tax and Financial Sector Policy at National Treasury, to have this conversation. I hope that you can join us and you can be part of this conversation on 011-883-0702. Let me greet my guest. Frans, thank you so much for joining us once again this week. I really appreciate your time, sir.
Good evening to you and your listeners, and thanks for having me once more.
Much appreciated. Delano Abdoll, thank you so much for joining us. Really appreciate your presence today.
Yes, good evening, Aubrey, and good evening to everyone who's joined.
And Haley Reynolds joins us for the first time this week, and she is Director of Tax and Financial Sector Policy at Treasury. Thank you so much for joining us, Haley. We really appreciate your time.
Good evening, Aubrey, and to all the listeners out there. Thanks very much for having me.
Let me start with you, Haley. Why is it at policy level does it seem that there are different rules for homeowners and businesses in the whole conversation around the tax rebate for solar panels?
Sure, thanks. So businesses will be doing this in the production of their income, and they're involved in a trade, of course, to produce income, whereas individuals are not in the same boat. So firstly, businesses, let me just tell you a little bit about the incentives and the difference. So businesses that invest in assets that are used for the generation of electricity from renewables, which include solar power, wind power, hydropower and biomass, they are allowed to deduct 125% of the cost of those assets. So if a business spends 100 Rand, it can deduct 125 Rand from its income to calculate its tax, whereas individuals can claim a 25% rebate against their tax liability, wow. And that's limited up to a maximum of 15,000 Rand. So that's the difference in the two of them. And then with respect to the time period, so individuals have been given a 1-year period, which started on 1 March this year and runs to the end of February next year, whereas businesses have a 2-year time period in which to invest, also starting on the 1st of March of this year. So both incentives are temporary in nature. And this temporary incentives with shorter time spans have been shown to be more effective at encouraging a larger behavioral response sooner. So in this case, the behavioral response that we're hoping for is additional generation capacity from renewables. And then when we compare individuals and businesses from an administrative cycle perspective, all individuals have the same tax year. So that runs from 1 March to the end of February. However, for companies, that's a little bit different. So they all have different financial year ends, and we recognize that they may need a little bit more time to plan for these investments, so hence the longer period for them. So I hope that gives a summary of the difference between the two.
Sure.
Thanks.
Frans, is it possible that a business let's say a family-owned business, can purchase solar panels for their home for domestic use? And how do things change then, Franz?
So you said family-owned business. So
Yeah.
we'd have to be clear what we mean by that. So if you had a company that was owned by a family, they would be two separate entities. And so you would treat them separately. But if what you mean by a family-owned business is what we would call either a partnership or a sole proprietorship, in other words, they're doing business in their own hands, then things get a little bit more complicated because they could be doing business from separate premises, in which case, well, that's easier. You can separately identify the business premises and they would get the business deduction on that side of things, and then for their home, they would get the individual rebate. Now, where it does get complicated is if you have the business being run from the home. And when that happens, well, you'll recall, or perhaps I'm not sure that we discussed it last week, but the business deduction then takes priority. You can't claim a rebate in respect of assets for which the business deduction has been given. So we'd be into the question of how much of the home was being used for business and a portion of the power needs plus the domestic purposes and the business purposes. For the domestic purposes, you would not receive a rebate, but for the business purposes, you would then receive the deduction that Heidi has described.
Delano, anything that you would like to ask to help us understand some of these concepts a little deeper, just to help us connect some of the dots a little more so that we understand how, as consumers, we approach this matter?
So, Aubrey, I think both guests have given a great introduction and a great lay of the land as to what the key differences are. And I think it's pivotal for the general public to be cognizant of how, when we speak about the businesses, we are referring to a deduction reducing the taxable income, as opposed to with households, we were referring to the rebate and tax credit, so reducing the tax liability. That's key for me at this moment.
Why is that? I suppose from my point of view, Delano, and I'm not educated at all about taxes and so forth, it just feels like discrimination.
That's quite a statement, but it's something I think we can unpack. Perhaps what are the main reasons for that difference?
Well, let me ask Franz, and then maybe I'll go down the. Hey, Franz, I mean, again, I'm not a tax person technically, but experientially, I'm listening to what has been said, and it just feels like, oh man, why did the businesses get to? Whereas I, as an individual, am contributing as much, I suppose, relative to who and what I can afford, to the project of trying to slow down the demand so that we can sort out our power crisis.
All right, so bear in mind, there are different factors here. The starting proposition for individuals is that domestic expenses are not deductible. So what we have here is something of an exception to the rule. So I think that's the departure point when you're looking at it from an individual perspective.
Yeah.
When you're looking at it from a business perspective, the departure point is that all expenses which are incurred in the production of income are deductible, unless they're of a capital nature. And if they are of a capital nature, then very frequently wear and tear allowances or some kind of allowance is permitted in respect of that capital deduction. So your starting points are sort of at polar opposites. And then I think that helps you start understanding why they are treated differently. The question you may then ask is why a deduction for the one and a rebate for the other? For an individual, a rebate is simpler because we don't get into the question of what kind of tax rate we're dealing with, because remember, individuals have a sliding scale for their tax rate. So there it's clear it's a 25% rebate. On the business side of things, well, business are used to dealing with it. If you're a company, it's a flat rate anyway, 27%. If you're a partnership or individual, you're already used to dealing with having to account for your income, your deductions, and so on. So you're on familiar territory there.
Haley, let me move on to a different question altogether. What's the rationale for providing a 2-year window period within which to claim the enhanced renewable energy tax incentive for businesses, where individuals who claim the rooftop solar energy tax credit are only afforded with a 1-year window period? It sounds like a policy decision.
Sure. Well, partly administrative as well. So that was something I alluded to earlier. So just for context on incentives being temporary, we find that incentives with shorter time spans generally are more effective at encouraging a larger behavioral response sooner. And when we think about the difference between individuals and businesses from an administrative perspective, you and I, when we file our taxes, our tax year runs from the 1st of March to the end of February, so we're all alike in that manner. However, businesses are a little bit different, so their financial year ends span throughout the year. So we've got companies with June year ends, December year ends, and those might straddle the fiscal year as well. So in terms of planning and internal approvals and so on needed for investing in projects like this, we thought that it'd be better for businesses to get a slightly longer period. And of course, in addition to that, these things cost government, or providing an incentive costs government money. So these incentives and their time span were also designed with the budget constraint in mind. So it's trying to balance all of that.
Delano, let me ask you this question. I mean, there have been ways by which businesses have been able to creatively purchase things that are used domestically and still then be able to use whatever breaks government provides them for business. Is there a possibility that businesses will be doing the same thing for solar panels in that same vein in this situation? And what are the things that we need to be aware of in this space?
Well, I think for me the starting point really is to recognize the electricity situation in South Africa is pretty dire, and we're all looking for an alternative. So to say that businesses will approach this in a particular vein as to, perhaps with a negative connotation, I'm not too sure that's the frame of mind, really.
Yeah. Frans, I'm sure you encounter that scenario a lot, where, and I imagine that's unethical behavior when people will buy something for the home, purporting it to be for the business, in lieu of the benefits and the tax rebates that come because of that. What do you say to somebody that's thinking that way?
So I would say that you are very likely to run into SARS' strategic objective 3, which is to make it hard and costly for people who don't wish to comply with the law. Because that's, at the bottom line, what you're doing. You're trying to step out of the framework of what the law will provide, and you're trying to use a benefit for something that wasn't intended for. Just to build a little on what Haley had to say earlier on the question that you had on 1 year for individuals, 2 years for businesses. Just remember the range of initiatives business can get into are also somewhat broader. And if you think about things like biomatter and wind turbines and hydro schemes, these are things that would require a fair amount of planning and then construction. So you're not necessarily, you may be in the simpler solar space that a household would use, but you may be well in one of the the more exotic, and I put that in inverted commas, forms of renewable energy where your investment is perhaps a little bit more difficult to get into the ground, on the roof, wherever it needs to be. And that's why you'll see that particular incentive also start talking about things like covering the foundations. It just gives you a sense that we're dealing with a much bigger project, and that is likely to take a bit longer to get into operation.
Will a business qualify for the enhanced renewable energy tax incentive where the machinery, plant, implements, utensils, and articles used in the production of renewable energy were acquired in any manner other than by means of an installment credit agreement as contemplated in Section 1 of the Value Added Tax Act, for example, by means of a cash purchase? Before I ask who should answer that question, Delano, I want you to help me understand what that question means, because this is one of the things that I asked you to help me with.
So, Aubrey, I agree. It's quite a mouthful, really, when we read in the law. But we're dealing with a piece of draft legislation which is expanding on existing legislation. And in its current draft format, the section that's applicable, 12 Cap B, Cap A, it mentions that this enhanced deduction in respect of these certain machinery, plant, implements, utensils, and articles used in production of renewable energy, it's classifying taxpayers whereby these items are owned by the taxpayer as purchaser in terms of an agreement contemplated in paragraph A of the definition of the installment credit agreement.
Yeah.
Now, that might sound like a repetition of what you've said, but there seems to be a slight difference as to what the draft version says in comparison to the current existing Section 12B.
And would you say that's a policy question or an operationally implementable question for SARS?
I think it's both.
Well, let me start with Haley then. Haley, help us out. How do you respond?
Sure. So I'm not a lawyer, I'm an economist, so let me try to do it simply.
Sure.
Basically, the policy intention is that the ownership of assets is a requirement to claim this incentive, and that's regardless of how they are acquired. So if a taxpayer buys an asset with cash, they'll be eligible, assuming the other criteria are met. If they use loan funding to buy that asset, or whether there's an installment sale agreement and they are the owner, they will be eligible. However, we are aware that there are two missing words in the draft legislation that has led to this uncertainty, and this will be remedied in the upcoming 2023 Tax Laws Amendment Bill. So those specific two words should mirror 12B, the current incentive. And yeah, I guess this is why public consultation is so important, because we always value feedback from the public, and it helps us to ensure that there's policy certainty for taxpayers. So I hope that helps.
Sure. France?
I think Haley's covered it. There are two words missing. Thanks for pointing that out. And the drafters will be working to put those two words back.
Okay, let's move on to the next question. Are inverters, batteries, fixtures, and fittings included in the definition of machinery, plant implements, utensils, and articles used in the production of renewable energy which qualify for this incentive? France?
So I'm going to have to use my general rule escape clause here, but as a general rule, yes. The reason I say that is you always need to look at the specific facts of each case, and there may be cases where something strange is happening, but as a general rule, the answer is yes to that.
Delano, what is the implication of that answer?
I think that covers it, to be honest, Aubrey.
Okay, all right. Anything that you would say as far as that is concerned, Haley?
No, nothing to add in that regard. And SARS is responsible for the legislative interpretation, so it wouldn't be right for me to say anything anyway. I don't want to get any of my SARS colleagues into trouble, so happy with that. Thanks.
All right. Does the cost incurred by a business to acquire this asset include finance charges and delivery costs, Frans?
So the answer to the finance charges is no, because what we're looking at is the cost on a cash basis. So that excludes finance charges. Finance charges would probably be deductible elsewhere in the Income Tax Act, but they don't come in under the amount which gets the accelerated incentive. When it comes to delivery costs, that's a little bit of an odd one, because generally that would be included in the installation costs. I mean, if you're a large business and you contract with someone to install your biomass renewable energy source, the delivery of the components to site would generally be included. So the answer there would be yes. Unless something very odd is happening, but as a general rule, yes, delivery would be included.
Anything that we would need to understand about that as consumers, Delano, that you would like to sharpen?
So, Aubrey, it might seem like very short answers, but maybe just to also give context, it's a discussion that's really different to the one we had last week, in the sense that we're dealing with an extended incentive as opposed to a new incentive. So, given that this has been an incentive that's existing in our law, some of these things are pretty much clear, but again, in its draft format, we are hoping that public comment might expand and perhaps sharpen what needs to be sharpened, whether it's 2 words or not.
Are we still in that process of getting public commentary, Frans?
Yes, we are.
Okay. All right. And then final question. Will the recoupment provision contained in the proposed section 12BA5 also find application where a business disposes of premises to which the renewable energy installed is affixed? Frans?
All right, so let's just step back a bit and give a bit of context to that question. So in a business, if you claim an allowance on an asset, so let's assume you had an asset that cost 100 and you got an allowance that reduced its value to 0, and then you sold the asset for, say, 70, you would be taxed on the 70. Because, so that's the starting point. And you'll remember when we had the discussion last week with individuals, the answer there is, generally speaking, no. As an individual, you don't have a recoupment. There is a very narrow case where you have a recoupment of the rebate you gotten as an individual, and that's if you sell the panels themselves. But if you were to sell the house to which they were affixed, there is no recoupment.
Right.
And even if you were to sell the panels, it's only if you sell the panels before the 1st of March 2025. So essentially, that's just a rule to stop people gaming the system.
Yeah.
In the business context, however, and that's why the two contexts are quite different, there's already a set of rules that apply that say, yes, there is a recoupment, and so the business would be taxed if they dispose of the property to which the solar panels or the wind turbine or what have you is attached. But now you've referenced a specific subsection. So let's just go back to my example of the 100. So you've put in your renewable energy assets for 100, and in this context, that could be 100,000 or 100 million, not sure which. We're talking business now. Now you get your allowance that doesn't just take it down to 0. Remember, you got 125%. So you effectively now have a negative 25 as the value of this asset, if you think about it conceptually.
Yes.
So now when you sell it for 70, you would get a recoupment of the additional 25% as well as of the actual cost. And that's all that section is saying. So just as you got an enhanced deduction, so when you sell, you get an enhanced recoupment.
Haley, the process is still in, I suppose we're still in the process of trying to get as much public commentary as possible. How flexible is policy making on this matter, depending on what comes back from the public consultation process?
Sure. So just to give a date to that, the public comment period is open until this coming Monday, the 15th of May, and we would welcome anyone listening to send comments. I can give the email addresses to your producer afterwards if you would like. And in the point of public consultation is for government to put out a policy that in tax policy specifically, both Treasury and SARS work closely together because obviously first and foremost, policies need to be implementable. So that's the first step. And then when we put that out to the public, we value their opinions because sometimes if a particular measure is proposed and businesses for some reason are not able to execute that or there's a relevant problem that they raise, then we have to take that into account. And we also are required to present all policies in Parliament, and taxpayers or the public are provided with an opportunity to present their concerns and questions as well, to which we have to respond. So we value this process, and on these policies specifically, that is the case for every policy. I cannot tell you that the policy is in stone. But obviously, because this one is short-timed, it's already started, policy certainty for investment is key, and that's why we try to get the legislation out as soon as possible after the budget, and is why we're doing an earlier batch of the legislation compared to the usual bill, which goes out in July.
All right, Haley Reynolds, Director of Tax and Financial Sector Policy at Department of Finance at the Treasury. Thank you so much for joining us this evening. Hope that we'll be able to have chances to talk a little bit more about other policy issues. Really appreciate your time.
Thanks, Aubrey. It was a pleasure.
Much appreciated. Frans Tomasek, again, thank you for joining us this evening. We really appreciate your time.
Thank you. As Haley says, our pleasure. It's what we're here for.
Thank you so much. Frans Tomasek is Head of Legislative Policy at SARS. And again, Delano, I want to thank you for being my crutch in these conversations. He's a cross-border taxation expert, and he is from a company called Tax Consulting SA. Delano, thank you very much for joining me this evening.
Thank you very much, Aubrey, and thanks to the guests.
Much appreciated.